What's going on YouTube? Mike here, back again with the 9th video in 5-Step Forex, a free smart money concepts trading course. And in this video, we're going over step number 4, talking about entries, how to place them, and the different types of entries that we have available. So before we get started, make sure you're subscribed to the channel, turn on your notifications, because we are working on wrapping up this course and we're on the tail end of it and working towards actually putting it all together. So definitely don't want to miss the end of this course. Also, if you're just stumbling upon these videos, or this video particularly, you are, like I mentioned, in the 9th video of an 11-part series that I'm using to launch my YouTube channel. So if some of this stuff doesn't make sense, be sure to go above or below you somewhere on the page and find the playlist that this video is a part of. And you can actually watch this free course all the way from start to finish and find all of the 5 steps that are part of 5-Step Forex. So today, like I said, in this video, we're going to talk about entries, and we're actually going to go over risk entries. I mentioned in the last video, I talked about confirmation entries, double confirmation entries, and refining our entries in my in-depth course. So if that's something that you want to learn more about, be sure to check the links in the description below. And today we're just going to talk about risk entries, the set it and forget it method. In creating this course, I wanted to create something that was easy for people to come in and just get a basic understanding and be able to work with that. And I would imagine that most people watching this are working jobs where they don't necessarily have time to always be staring at a chart all day, and they may not even want to stare at a chart all day. And so I created this. Well, I didn't create this. I'm putting this course together so that people like yourself can actually just have a really simple trading strategy that offers really high risk to reward setups, and really ultimately not have to spend a whole bunch of time charting and learning a bunch of indicators and strategies that ultimately don't offer the same principles that trading with smart money and refined supply and demand does. So that being said, there are a few examples that I'm going to go over with in this video, one of which you're actually looking right now. And I want to keep the focus of this video on entries and like where to actually place them, how to draw. We'll kind of touch base on how to draw the point of interest again, but there are going to be topics that I just have to add in that we've already learned from the last videos. So don't get confused on the entire process yet, because I'm also not adding the entire process in until the end of this course. We're going to actually put everything together in a conclusion video where it's just one fluid start to finish framing a trade. And I just don't want you to get confused yet, like in this part of the course. So if there's stuff I'm talking about, like I already said, then make sure you check out the videos before this one, before you continue on. And let's go ahead and get started. So in previous videos, we talked about break of structure as well as supply and demand. And I want to actually add in entries using that framework. So right here is a beautiful point. And there's actually, there's all sorts of different trade entries that you can find just on this screen. But I want to go over this perfect one right here just to show you, the simplicity of it. And then after I show you this example, I'm going to show you times where it doesn't work. And so that you're not, I don't want you to think that this is going to work 100% of the time. Literally nothing in trading works 100% of the time. But I feel that I have to show you really clear setups so that you can see it. And then I'm also going to follow it up with times where it doesn't work and times where, it's not that simple. And so basically what we have here is a retracement. Overall, you can see this entire trend is very bullish, but we have a bearish retracement here, and then followed by a continuation, and we can see a break of structure here on the chart. And so at this point, if you're watching this chart live and you saw this break of structure, we can then assume that at some point in time, this is actually going to retrace down into this zone, create a new low, and then continue and break structure again right here. Okay. And so basically with the entries, what we talked about in the last video is that we're basically just using supply and demand zones to create a point of interest, or to create a high value zone where price is likely to come back to and likely mitigate and continue the trend. Okay. So in doing so, what we can see here is a demand zone, which is this last down candle before the up move. And I have my my box tool that I'm drawing onto this candle. I'm using control. You can, once you draw this on the chart, you can use control or command to snap it to the top of the candle. And then again, you can use control or command to snap it to the bottom of the candle. And then you just drag it all the way out. And in a live market, you just drag this out a few days or a few, if you're trading a lower time frame, a few candles out, it doesn't really matter. And you can then just set an alert on top of this box right here. Okay. And this is typically what I will do if I'm doing pending orders like this, is actually add an alert using the trading view feature on top of the box in a buy example. We'll go over sell examples in a minute. This is for a buy or a long position. And so essentially I just marked up a demand zone just like we did in the last video. However, on your broker, what you're actually going to do is set your buy limit here at the top of this box. And then you're going to set your stop loss below the bottom of this box. And all you need to do is just wait for price to actually retrace, and it would then trade into this zone and ideally move away. Now, again, there's going to be times where it trades right through it, hits your stop loss and reverses, or just wicks your stop loss and continues. But essentially, the point of this is to have like I mentioned, a really easy way to just set it and forget it with trading. And so now I'm going to go ahead and slap on my risk to reward tool, and I'm going to set the entry at the top of this. And I'm just going to show you like a little bit more visually where your stop loss and where your entry would go. And then we'll go over in future videos, we'll go over where you'd actually take profit and the targets and stuff like that. So stop loss, again, right below, just a few pips below this low of this candle, which we have annotated by our drawing tool, our box tool here. And then the entry again at the top of this demand zone, which is the last down move before the up candle. And so some of you may be wondering why I have this actual bull candle highlighted. And this is something I go over in my in-depth course, but essentially I have this refined to this last candle that wicks the low. So this is the actual low of the move that broke the structure. And I personally, in part of my trading plan, is actually refining it to this. So some of you, if you had this area selected here, this entire candle, that's not wrong because it is the last down move before the up candle. However, I'm refining this to this candle here because if you go down to a lower time frame, there is one last down move that's inside this wick that wicks this low. Also, if you had this refined here in this particular example, you would not be wrong if you had your zone refined to this candle and this low. There's many different ways to refine, and I talk about all those in my course. So if that's something that you want to learn more about, be sure to check the links below this video. Anyways, to carry on, like I was saying, your buy limit in this example would be at the top of this candle and stop loss below this candle. And so the risk to reward on this trade, I mean, obviously, depending on where you take profit, it's very high. But essentially, to the next high that we have is right here. And so as you can see, like we mentioned in the last video, this trading strategy and using smart money concepts offers a very high risk to reward ratio, and it offers really pretty consistent setups. And so now I just want to talk about where this would have actually entered and why some people might want to use confirmation orders and also refinement. So if you had seen this break of structure, and at this point, somewhere in these first couple candles, you said, okay, I'm going to go back here for the last low before the up move, going to highlight as my point of interest. I'm going to set a pending limit on the top of this. And that actually got hit, then you would have actually entered on this candle right here. And you would have been ranged for what looks like, this is the 4-hour chart. So that'd be basically somewhere in this candle. And then you have 4, 8, 12, 16, 20 more hours of price just dancing right above that point of interest before it actually moves and carries on. And so I can just see, just by looking at this example, that there is actually a confirmation order, a confirmation entry in these candles here. And this is something, like I said, I go over in my actual course, my in-depth course, my paid course. So if you are not the type of person that wants to have an actual ranging market where it's just sitting here bouncing around before it actually takes off, then that might be something you're interested in. Otherwise, this is kind of what happens, and these are kind of the downsides to this strategy, or this method of entering a trade, is that you can actually have price just kind of bounce around for a while before it actually moves. And it looks like this moves, later on, or no, yeah, this actually moved in the New York session of the next day, is when it actually started to take off again. So you would have been tagged in at, looks like, 9 a.m. New York time on Thursday, January 5th of 2023. And it would have actually moved in your favor sometime around 5 a.m. the next day on Friday, the 6th of January, 2023. So if you want to find those on your chart and mark it up, you can do that. And so let's go ahead and continue on now with a few examples that don't work, that you would have taken a loss, and also with examples where you don't get tagged in, just so you know the expectation and you can have a realistic expectation for yourself. So right next to this order, I actually do see a situation where this actually failed. Remove my alert really quick. So we can see right here, there is a break of structure. It's actually really clean. Right here, you can see a bearish correction and then bullish continuation that did break structure. So if you were looking here, using this strategy, you definitely would be right in assuming that this is the last down move before the up move that broke structure. And you could have set an order right here at the top of this box where you would have gotten tagged in on this candle. And you could set it for, we'll talk about entries and targets in the next video, but you can set it for whatever aligns with your trade plan. You would have gotten tagged in on this candle. It would have ranged for a few candles before wicking this low, and then taking out your stop loss and then continuing in the direction. And so in the previous videos, we talked about break of structure versus a wick. It didn't actually break the low. It just wicked it, which we consider a liquidity grab. And that is then validated by the fact that price launches on away from this zone. So they came down, they mitigated this demand zone, they then wicked that low to take the stop losses behind it and then continued on. And so again, using confirmation-based entries, you can, ideally, most of the time, you can help avoid situations like this, because on a lower time frame, you're looking for confirmations of the trend continuing. And it would then help prevent situations like this from happening, where your stop loss gets wicked. Obviously, like I've mentioned and made very clear many times, nothing is 100% in trading, but using the confirmation entries, double confirmation entries, and refinement adds a whole other level of confluence to our trades. And so this has been an example where it does not work. And I'm doing this just to show you that nothing is 100%, nothing's going to work all the time. So now let's go ahead and go on to another example. There was one up here. So right after this first example that we looked at, we can see where price then went on to break structure again. And so if you mark this break of structure, you would be then waiting for price to come back down to the last low or the last down candle before the up move. And you can clearly see that this did not actually get tagged in. So in this example, like we talked about in the overview video, there are times where it may not tag you in, and you need to wait for the next break of structure to find the next point of interest to place your trade and frame your trade around. So this, again, is a downside to this side of things. However, if you understand confirmation entries and refinement, you can actually see that there is a trade set up in here that is actually valid, and would you probably on a lower time frame, I don't actually know, but looking at these candles, I can see that it's very likely that there would be a trade on the lower time frame in here using confirmation entries that we could have gotten in to continue riding this trend. So once we have a break of structure again, we do have a little pullback here. Again, from this break of structure, there's a pullback from here to here, and then price continues on from continuing the trend. So we can see a break of structure at this point right here from this high. After this pullback, and price, what does it do? It then pulls back into this zone. So the very next 4-hour candle, if you're just watching the 4-hour charts, you would have come here and you said, okay, last down move before the up move that broke structure. you can see the very next 4-hour chart would have wicked you in. So your risk to reward tool, just to visualize this, would go here, entry at the top of the box, stop loss below it, and risk to reward, whether you're using predetermined risk or new highs or whatever you're using, you would aim for the trend to at least continue in some way, shape, or form. And we can see using the 4-hour chart, it did wick, retrace back up in, and then it traded back down into that wick before continuing on to break structure. And so again, right after this, we can see a few more examples before we move on to some sells. It did break structure, not at this wick right here, but actually at this candle, at which point it returned back in, last down move, or if you're refining it to the lower candle, it did come in, tap this zone, and continue. So in this example, this would be a pretty low risk to reward example, but you can use this candle here as your point of interest, the demand zone, and we can put our risk to reward on. You can see here at this point that price would have, after the breaker structure, immediately retraced, and it would have ranged in this for almost 2 days, it looks like, inside this point of interest before it continued on. And so again, inside here is very likely that there is a confirmation or a double confirmation entry that we could have refined down to. If you are not into that, then you would have, and you wanted to use, the set it and forget it method, your trade would have been triggered in this candle, and it would have then ranged for quite some time, as you can see, before continuing on. And again, this is not a very high risk to reward setting. So using the refined entries and refinement in this case would have, if there was a trade, would have yielded a much higher risk to reward. And so we can then see price breaks the structure, comes back down, mitigates the lower zone in this POI, and then continues on. And so now I'd like to go ahead and show a few examples of sells and a few that don't actually get tagged again, just to show you exactly what we're talking about. And so here we have an example of a supply zone and breaks of structure in a bearish trend. And I'm going to go over a few examples where it either doesn't work and where it's actually mitigating swing structure instead of the expected POI. Okay, and so at this point in the chart, you can go back and follow, price action, see what's happening. But so we have a last up candle before a down move that breaks structure. We can see here, this is actually a break of structure. So at this point in time, using the strategy, you would then set a pending order right here at the open of this candle, or the low of this candle in the low border of this POI, stop loss right above it. And then whether you're using predetermined risk to reward or targeting an old low or an old high, something like that, which we'll go over in later videos, we would then expect for price to actually come back in here and mitigate this and continue on. But as you can see in this example, it came just a few pips below it. So in the 4-hour charts, it missed it by about 5 pips, it's very frustrating when that happens. However, if we drop to a lower time frame, we may actually see that there is a confirmation entry on a lower time frame that we could have taken, which would improve our risk to reward and also make sure that we actually catch the continuation of the trend. Okay, so now what we can see, moving on to the next example, is we can see a time where price actually traded through the stop loss, but it was actually trading what appears to be swing structure. And so this is not something where I'm going to go in depth in swing structure, but overall the trend clearly continues bearish. And so yeah, we're just going to use this example really quick without going super in depth. You can see here we do have a breaker structure. So whether you're marking it from right here or from this candle low right here, regardless, this is the breaker structure. This is the last up move before it broke structure, and you in this example would have set your pending order right here with the entry on the bottom of the supply zone and your stop loss at the top. I don't think I mentioned this yet. This would be called also a sell limit on your broker. So when we're selling, it's a sell limit. When we're buying, it's a buy limit. Pretty needless to say, but I'm assuming that there are going to be people who don't know these types of orders in their broker. And so you would place your sell limit on the lower section on the bottom border of the supply zone, and your stop loss would go right above it. And you can see right in this example, this candle would have actually triggered you in, and in the same candle hit your stop loss, or I guess shortly after this candle closed, it hit your stop loss, traded up to a higher point of interest, which you can see here. It did wick that and then continued on lower. And so this is not a great example, but this is one example of swing structure and where we could have used confirmation and refinement in order to keep us out of a bad trade. However, you could have also, I guess, if this follows your trade plan, you could have had a pending order here as well as here, because it is obvious that this order or this buy to sell candle here and this buy to sell candle here did not actually get mitigated. It would be actually pretty highly probable that price comes back to at least mitigate one of these. So if you could have had two pending orders in this range to get triggered in. So had you had a pending order here, the stop loss would go above the upper border of this point of interest, and then your sell limit would go at the lower border of this point of interest, and you would have gotten the wick entry right there for the continuation on this move. And so depending on your trade plan and your take profit points, and if you're targeting structure or you're using predefined risk or you're leaving partials running, whatever, we can see that the trend continues and obviously goes off for quite some time. And so this pretty much wraps up the walkthrough on how to actually add entries to your charts, and also obviously use this on your broker. One thing I just want to make clear really quick for anyone who's totally new to trading, if you've never even placed a trade, you're not actually placing trades on TradingView. At least I'm not. I'm actually using a different broker that's on a second screen to place a trade. So most people, if you're like totally new, you've never placed a trade, a lot of the times most people will come into the trading world using MetaTrader 4 or MetaTrader 5 that's connected to their brokers. And that's where you're actually going to be placing the trade. TradingView for me is just a visual tool. And so as time goes on and TradingView becomes a better platform, they do actually have brokers integrated into TradingView. But that's just not something that I'm using at this point in time of filming this course. So that's why some of the references that I'm making, like I'm actually placing a trade on a separate window using MetaTrader 4. So I just wanted to add that in and clear it up. So once again, thank you for watching. This is video number 9 in 5-Step Forex, where we're actually walking through applying entries to a chart. Make sure you subscribe to the channel, turn on notifications. We are getting closer and closer to the conclusion of 5-Step Forex, where we actually apply all 5 steps to a chart in one fluid motion. And you're definitely not going to want to miss that. So once again, thank you for watching, and we'll see you in the next video.